Hi, thanks for joining me today. This is Dee Dee Jones talking with you today about taxation and your investments. Specifically, will your investments be taxed? We need to start at the very top to break this down and talk about the different elements of taxation when it comes to investments. First of all, if you hold an investment and haven't made a sale of it, there's probably not going to be tax associated with it. Now, sometimes there'll be interest or dividends paid on that investment. If it's held outside of a retirement account, a qualified account, there will be tax on that income. So that's an easy one we can knock off the list, but it starts getting crazier fairly quickly. So if you've sold an investment, let's walk through the steps to determine whether or not you're going to owe tax on that sale. The first question is, where did you hold the investment? If it's in a qualified plan, like an IRA, a 401k, a qualified retirement plan, or a qualified annuity, which is an annuity that is part of a retirement plan, that sale is triggering no tax whatsoever. What will happen is money that comes out of any of those types of accounts will be taxed, every single dollar, at your ordinary income tax rates sometime in the future when you're drawing against that. So no tax now when you're making changes in your retirement account. So that's kind of nice. Makes it easy to do the rebalancing that all of us financial advisors want you to do to keep things in balance and keep your risk managed. So if you're curious about the sale you made in your retirement account and that's your only question today, you're off the hook. You're done. Go have a great day. For the rest of you who have sales of investments somewhere else, there's different rules. So if your investment was held in a regular annuity, for instance, again, there won't be any immediate taxation on that, but that regular annuity, the monies that will be distributed later will be allocated between cost basis, what you paid for the annuity, and the gains on the annuity. Now, those gains, unlike the ones we'll talk about in a minute, gains on distribution in an annuity are always taxed at ordinary income tax rates, which have traditionally been higher than the long-term capital gains rates we're about to talk about. So now we're to the meat of the question. Most folks will experience tax issues on investments that have been held in a non-retirement account. So the first thing we're going to look at, when you sold that investment, did you sell it for more than you bought it? Hopefully, did you have a gain on it? If you didn't have a gain, then you could have an unrealized loss, which could reduce your tax liability. Hard to use those if you don't have gains to offset them against. You can only use $3,000 per year, but they have value. So don't lose the record keeping on that. If there's a gain, if you sold that asset for more than you purchased, then we have a gain that we probably will be subject to tax. Now, you'll run into the word cost basis. Generally, that's how much we paid to acquire something, be it an investment, a company, your house, whatever. That's what cost basis generally means. The next thing we need to know is, how long did you hold your investment? If you held it for more than 1 year, we have special rules. If you held it for less than a year, then your investment gain will be treated as a short-term capital gain, and you will be taxed on that based on your income tax bracket, your ordinary income tax rates. There's other elements of this we'll come back to in a minute, but if your investment was held for a year or more, that gain qualifies for special treatment. That is long-term capital gains treatment. And the rate you're going to be paying on that is going to be dependent on your taxable income rate. So if you had taxable income, so this is all of your income less your deductions, is less than $80,000 if you're filing married, guess what? Zero tax rate for you. So if you have a situation where you have a lower income year, but you have an appreciated asset you'd like to sell, that might be a great strategy to sell that in that low tax year, because there is such a thing as a zero tax rate on long-term capital gains. I think it's pretty cool. Nice tax planning opportunity for folks out there. And if that's the case, that's the end of the story. The rest of these situations have little tails that follow along. So Lots and lots of folks will fall in the middle category. So this is taxable income for married folks of $80,000 to $496,000. Singles are $40,000 to $441,000 for single folks. And estates and trusts, this is really interesting, very tiny, $2,600 to $13,000. So their little tax bracket is very, very tiny for this middle rate. And the middle rate is 15%. And finally, if your income exceeds those, so single folks of $441,000, married folks of $496,000, and estates and trusts $13,150, the gain is taxed at 20%. So by and large, most folks will be taxed at that 15% tax rate. With good tax planning, they might be able to be in that 0% tax rate. But that's that special long-term capital gain rate that we like about investments. It's advantageous. The idea is folks who design the tax code have deemed investing to be a preferred activity, and so they want to encourage us to participate by giving us a break on our taxes. Now, if you happen to have had your modified adjusted gross income exceed $200,000 for single people or $250,000 for married filing jointly, or that $13,000 for estates and trusts, you may be subject to the net investment income tax. We spoke about that last week very specifically. We'll put a link in that for that here if you're specifically interested about that. And if your income, including capital gains, is above $518,000 for a single person or $1 million for married filing jointly, you actually might be subject to AMT, alternative minimum tax. We don't see a lot of folks fall into that these days, but once your income gets that high, it does come into play. And finally, it's good to look at how your income level might affect other taxation. The higher your income is, and if you're collecting Social Security, the more of your Social Security is subject to tax. And if you're over 65, higher income can result in what's called IRMA surcharges for your Medicare coverage. And finally, anybody who's paying tax on their investment gains is probably subject to sales tax liability. Here in Colorado, it's 4.63% on top of what that other rate is. So there's a lot of layers of taxation. Part of it depends on where the investment sits. That was our first cut. Then the next is whether or not you had a gain or a loss. Gains may be subject to tax. Then we look at how long you held the investment. Was it short-term or long-term? Short-term just gets ordinary income tax rate. Long-term, we get the preferential long-term capital gains rates. And there's even a 0% we can take advantage of. And then you want to look and see, are there other elements that might apply to you? Higher incomes might have the NIT. You might have alternative minimum tax. For folks who are retired or in their retirement years, there may be impacts to your Social Security taxation as well as your IRMA surcharges. So what seems like it should be really simple, did I have a gain or loss, pay tax on the gain, is actually a multi-layered, multi-level, complicated question. If you've got more questions about this or anything finance related, shout it out. We're happy to help you here. Dee Jones with Innovative Financial, helping you get mastery over your money. Have a lovely day.